Welcome back to Trader UK. Adam here. I hope you are very well. Last week, the UK government announced a 1.25% increase to national insurance, which comes into effect from April 2022. Of course, this was huge news and it impacts millions of people. But alongside that announcement, it was also revealed that the 1.25% hike will also apply to dividends. Today, I'm taking a look at what this means for us as investors. If you are not familiar with how dividend tax actually works, it's applied to your worldwide dividend income. So it doesn't really matter if those dividends are coming from UK companies or from overseas companies. And the rate of tax that you actually pay depends on your total income during a tax year. Basic rate taxpayers currently pay 7.5%, higher rate taxpayers pay 32.5%, and additional rate taxpayers pay 38.1%. Now, these rates will be in place for dividends received up until the 5th of April 2022, and then as of the 6th of April, the new rates on the right-hand side of the table will start to apply. Now, these hikes might seem pretty insignificant, but a 1.25% increase on what was a 7.5% tax for some people is actually almost a 17% increase. So if you've spent years building up a dividend portfolio, you might now face the prospect of paying an additional 1.25% national insurance on your earned income, plus another 1.25% on the dividend income that you've worked so hard to build up. So I want to take a look at how worried should we be about these changes and how much of an impact they will actually have on us. Before I go any further, I would be interested to know your thoughts. Let me know down in the comments what you prefer, dividend or growth. I know both have their benefits and on occasions you can actually achieve both, but if we had to choose one, which would it be? First point to make is that if you are holding your investments in a stocks and shares ISA, then these changes will not impact you. In fact, your investment is protected from all dividend taxes and capital gains taxes, plus any subsequent tax increases that our government might decide on. So if you haven't already, then make sure you are utilising as much of your £20,000 annual ISA allowance as you possibly can. You would not need to worry about these changes at all if that was the case. If your investments are not shielded within an ISA, then it's not necessarily bad news. Any dividends you receive could potentially be covered by your personal allowance, again, meaning that they would be tax-free. But for most people, the personal allowance of £12,570 is already being utilised elsewhere. Employment income, self-employed profits, rental income, by the time it's all accounted for, most people don't have any personal allowance remaining. The good news is that on top of the personal allowance, we all get an additional dividend allowance of £2,000 per tax year. It doesn't matter how much you earn, it doesn't matter where your other income comes from. If you are a UK tax resident, then you'll be entitled to this dividend allowance. Now, £2,000 of dividends is actually quite a lot. Even if you could find a nice little dividend paying company with a 5% yield, you need to hold about £40,000 of that stock to generate a £2,000 annual dividend. This means that those with a smaller dividend portfolio should avoid the tax altogether, even where their investments are kept outside of an ISA and where their personal allowance is being utilised elsewhere. But there are plenty of people out there with dividend portfolios in excess of this, and where their portfolios aren't shielded by an ISA, this is where that tax will start to apply. Initially, a rate of 8.75% will apply, which I would say is pretty manageable. Those people should already be used to paying 20% income tax on their employed income or self-employed income, so this rate actually looks pretty favourable. Now, for me, the 8.75% is not ideal, but I could live with it. Beyond that, though, we're moving into the more substantial numbers. 33.75% for higher rate taxpayers is just too much. And I personally would not be building a dividend portfolio or expanding on a dividend portfolio, knowing that I would suffer that rate of tax. And for those people who think, well, it's only a third, that seems pretty fair. We suffer a similar amount on our earned income by the time you account for income tax and national insurance. Just remember, in order to distribute these dividends to us, the shareholders, these companies have already had to pay corporation tax on their profits. Now, corporation tax itself is due for its own tax hike from 19% currently. It's rising to 25% in 2023. That means that for every £1 of pre-tax profit that a company makes, it will only end up with 75 pence that can be distributed to shareholders once it's paid the corporate taxes. Of that 75 pence, you, the shareholder, then pays more than a third in dividend taxes, leaving you with just over 49 pence from every pound of pre-tax profits. And then, of course, it's even less than that if you are an additional rate taxpayer. It's actually closer to 45 pence that the shareholders receive for every £1 of pre-tax profits that the company makes. Now, I'm going to do a more detailed video next week on why I would always choose growth over dividends, because there is actually a lot more to it than that. But sacrificing more than 50% of pre-tax profits just to get the money into the pockets of the shareholder by way of a dividend is not the best approach. So overall, I would say if your investments are shielded within an ISA, of course, you have nothing to worry about. If you're not already making use of your ISA allowance, then now would be a very good time to start doing so. Even when your investments are not shielded within the ISA, you would actually need to generate at least £2,000 of dividend income annually in order to start being impacted. And even then, if you're a basic rate taxpayer, the 8.75% rate should be manageable for most. But it's when you reach higher rate tax, that's gross income exceeding £50,270, that's where the dividend tax rates become unfavourable in my view, and I personally would be moving away from seeking dividend paying stocks at that point. That is all for today. Thank you as always for watching. Let me know your thoughts down in the comments and I'll see you next time.